Realty Income is one of the most popular REITs among individual investors, and it's pretty simple to understand why. It pays a monthly dividend, its dividend yield is nearly 5%, it has grown its dividend for over 20 years in a row, it has one of the best track records in the entire REIT sector, it has a strong investment-graded balance sheet, and it owns net lease properties that are occupied by household name tenants. But is it a good buying opportunity today? That's what we'll explore in today's video. Hey everyone, this is Jussi. I run an investment firm that specializes in REIT investing, and in today's video I'm gonna give you 3 reasons why I think that Realty Income is likely to underperform its net lease peer group going forward. But before I get into it, if I could kindly ask you to like this video. I just recently created this YouTube channel and I plan to make weekly videos on REIT investing going forward. Thank you very much. So reason number 1. I think that Realty Income has some of the worst internal growth prospects in the net lease peer group. Internal growth is mainly a function of 2 things for net lease REITs. It's the rent hikes in their leases, and then secondly, how much cash flow they retain to reinvest in growth. And on both fronts, Realty Income is actually quite a bit worse than its peers. Its rent hikes average right around 0.9%, whereas many of its peers have rent hikes that are closer to 1.5% to 2%, or even more in some cases. The reason why the rent hikes of Realty Income are so low is because dealing mainly with these very big companies like Walmart, Starbucks, McDonald's, and these tenants clearly they are very desirable, they are very safe, they have strong balance sheets, but because they are so desirable, they also hold a lot more bargaining power with their landlords. And so on top of that, Realty Income is also retaining relatively little cash flow. Its payout ratio is today right around 75%, whereas many of its peers are retaining quite a bit more with payout ratios at around 65%. Reason number 2, I think that Realty Income also has some of the worst external growth prospects in its peer group. External growth is when you raise more capital to buy more properties. And Realty Income has been very successful at this in the past because for most of its history it was trading at a large premium to its net asset value, which allowed it to raise capital at a low cost and would then buy properties at a positive spread. But this is now becoming a lot harder for Realty Income because it's really big in size. Its market cap is now over 40 billion. It's one of the biggest REITs in the world. And so it has to buy a huge amount of properties every quarter to keep the ball rolling. But there are only so many properties available for sale. There's a lot of competition now for net lease properties. And so cap rates have also compressed. At the same time, interest rates have risen. The valuation multiple of Realty Income has come down, which means that the cost of its equity is also higher. So now it's a lot larger, it has to buy more properties, which is more complicated because of the competition, and the spreads are also smaller. So external growth likely won't be the same going forward for Realty Income, but many of its peers are much better positioned here because they're a lot smaller in size. Some of its peers are more than 10 times smaller. And on top of that, some of its peers also focus on some niches of the net lease property sector that provide much greater cap rates. And so reason number 3, you're not getting a valuation discount for Realty Income, despite its lower internal and external growth prospects. On the contrary, you're actually today paying a small premium relative to some of its other peers like Essential Realty Properties Trust and Vici Properties. And so if you're getting slower growth, but you're not getting a lower valuation or higher yield to compensate for it, I think it's quite likely that Realty Income is going to underperform going forward. I think that its returns are still going to be relatively compelling because if you're paying a 4.5% dividend yield and then you grow by 3 to 4% per year, you're still likely going to reach 8% annual total returns, but I think that some of its peers are going to return closer to 12%. And so what would be a better alternative to Realty Income today? We think that Essential Properties Realty Trust is arguably the best opportunity in the net lease property sector today. Its ticker symbol is EPRT and it's our largest net lease position at Lumberg Capital. We like it so much because we think that it has better internal growth prospects, it also has better external growth prospects, But despite that, it's actually offered at a lower valuation, it pays a higher yield, and so you combine that all together, we would expect its total returns to be greater going forward. And this is also backed by history. Since going public, EPRT has actually generated roughly 2 times greater total returns than Realty Income. And so to recap, we think that Realty Income isn't the best option today in the net lease REIT property sector because it has relatively small rent hikes, its payout ratio is quite high compared to some of its peers, it's getting really big in size, which will slow down its external growth prospects going forward. And despite this, it's actually priced at a small premium to many of its faster growing peers. But this doesn't necessarily mean that Realty Income is a poor investment. I think that just depends on what you're looking for. If you're a conservative, income-seeking investor or you're a retiree, then Realty Income can make a lot of sense because it's paying monthly income that's very safe. As I mentioned earlier, it has grown its dividend for over 20 years in a row, despite the great financial crisis, the pandemic, the dot-com bubble. It has always managed to keep rising its dividend, and so it can be very attractive to conservative income-oriented investors. But if you're trying to maximize total returns, I think that there are better options out there. That's all I had to say on this topic. Thank you very much to all of you who stuck till the end of this video. Please let me know your thoughts in the comment section below. And then if you could like and subscribe, that will help me a lot. I just recently created this channel, as I said earlier. I do weekly videos on REIT investing. And if you want to get real-time news on my latest REIT investments, you can also follow me on Twitter. I'll put a link in the description of this video. And otherwise, see you at my next video. Bye-bye.